You've probably heard about it, right? This idea that there's a simple secret, a single line you can draw on a stock chart that tells you exactly when to buy and sell. The most famous one? The simple moving average. But is this trading secret really a secret weapon, or is it just a myth? Well, we're going to find out.
I love this quote from Charles Schwab because it just nails it. They say technical trading is a lot like surfing. The whole point is to learn how to read the waves, the market trends, so you can catch one and ride it for a profit. To do that, though, you have to know what you're looking for.
And for so many traders out there, the go-to tool for reading those waves is the simple moving average. The appeal is obvious, right? It promises to just cut through all the day-to-day noise and show you which way the market is really headed.
So what is it? A simple moving average, or SMA, is pretty much exactly what it sounds like. You take the closing price of a stock over a certain number of days, say 50 days, and you average it out. The whole point is to smooth out all the chaotic little price jumps you see every day so you can get a clearer picture of the real trend. Is it going up, down, or just moving sideways?
Okay, so here's where the magic is supposed to happen. Traders don't just use one of these lines. They usually use two, a short-term one and a long-term one. And when that faster short-term line crosses above the slower long-term line, that's called a golden crossover. It's seen as this huge, powerful buy signal. It's clean, it's visual, and it feels like you've just cracked the market's secret code.
It seems so easy, doesn't it? A simple rule to follow. But here is the multi-trillion-dollar question. Does actively trading based on these signals actually make you more money than the simplest strategy in the world? Just buying a stock and holding on to it.
So let's do it. Let's put these two ideas head-to-head. In one corner, we have the active trader trying to perfectly time the market's waves, and in the other, the passive investor who's just trying to stay on the surfboard and ride it out for the long haul. You know, it really boils down to two completely different philosophies. Active trading is all about timing the market. You're trying to jump in to catch the good times and jump out to dodge the bad times. Buy and hold is all about time in the market. You just ride out all the waves, betting that over the long term, the market will grow.
Now, to figure out who wins this showdown, we're not going to rely on opinions or gut feelings. Nope, we're going straight to the data from a 2024 research paper called Backtesting Brilliance. And what these researchers did was take years of historical data for some of the biggest stocks out there and just ran the numbers.
They basically simulated both strategies, the active trading and the buy and hold, over and over again to see which one actually came out on top. And well, the results are pretty eye-opening. Just take a look at the numbers here for Apple and Google. The buy and hold strategy gave a higher return, but look at that last column, the Sharpe ratio. That's a fancy way of measuring how much return you got for the amount of risk you took on. And here again, for Apple and Google, buy and hold wins. The active strategy meant more work, more trading, and more risk for a smaller reward.
So the final verdict from the study was pretty clear. For a lot of these huge, popular stocks, the simple moving average strategy just failed. It failed to beat the incredibly simple strategy of just buying the stock and holding on to it. The myth, it seems, is busted.
And it wasn't just a one-off thing. The study also looked at other popular, simple trading tools like Bollinger Bands and the RSI, or Relative Strength Index, and they found the same thing. These strategies also consistently underperformed just buying and holding. Okay, so if these simple rules don't really work on their own, does that mean technical analysis is useless? Well, not exactly. It might just mean our signals need to get a whole lot smarter.
So do we just throw all these tools in the trash? Or what if we start combining them? What if we build a more powerful signal that can look at multiple things at once? Something that a machine learning model could really sink its teeth into.
This is where things get really interesting. Another study proposed a much more robust approach. It starts with that same crossover signal we talked about, but, and this is key, it doesn't stop there. It adds layers of confirmation. It checks for a spike in trading volume. It compares the price to something called the VWAP, that's the volume-weighted average price, and only then does it feed all that information to an AI to make a final decision. So here's how that works in practice. You see the crossover, but you don't just blindly buy. Instead, you ask, okay, is there other evidence? First, you check for a big spike in trading volume. That tells you there's real money and conviction behind the move. Second, you check if the price is above the VWAP. That suggests the big institutional players are buying too. When all those things line up, the signal becomes way more reliable. So what did the research find? This combined, smarter, AI-driven strategy was far superior. It delivered higher returns for the risk involved and had smaller losses along the way compared to just using a single indicator. It turns out it's not about finding one magic rule, it's about intelligent combination.
All right, so after digging through all of this, what's the big takeaway? What does all this research and data actually mean for you, the everyday investor?
Well, it's absolutely crucial to remember the built-in weaknesses here. Moving averages are lagging indicators. They only tell you about the past, they can't predict the future. They're notorious for giving you false signals when the market is choppy. And a big, sudden price spike can totally distort the average and point you in the completely wrong direction.
And all of this leaves us with one last big question to think about. The evidence pretty strongly suggests that the hunt for one single perfect trading rule is probably a waste of time. So maybe the future of investing isn't about finding the perfect rule at all, but about building the smartest learner, a system that can see the whole picture, learn, and adapt.